Shane, how's it going?
It's going better for me than it is for the banking system in the United States of America and globally. Yeah, it's good, man. We hired somebody today, accepted our offer, so we're gonna have a new guy joining the team. His name's Tom, and he's gonna be helping me out on the portfolio management side with like lots of the operational stuff that I've been trying to do all on my own. So I'm looking forward to hopefully having some more time to dedicate to things like this and other initiatives. Yeah, I'm pumped to have somebody new joining the team. We've been running a tight ship with a pretty lean, lean, mean operating machine for a while. So it'll be nice to have some more help and hopefully free up a little time. So I'm a happy camper, Kyle.
As am I. I'm getting client calls here and prospect calls wondering, is the world ending? You got these bank failures taking place, and we'll get into that. But
Meanwhile, the market's trying to go higher. What gives?
yep. And it's just funny on that note, I was thinking about it. They always say it, markets tend to bottom when the big news events hit. And I'm not saying this is the bottom, but that's why it's so hard to trade is if you turn the news on right now, you want to short everything in sight. But,
Unless
if
you
you look,
turn on the Cartoon Network over at CNBC, they're telling you to go long regional banks because everything's fine, no big deal. That's
mhm,
just unbelievable. These guys are unbelievable. I cannot believe these people. I
yeah.
can't believe like they should. I don't know. I guess I'm glad they're not in prison. It's a free country. They can say whatever they want, but my goodness, it's so irresponsible.
Yep. So it's an interesting dynamic out there. We'll get into it here. So, look at the charts and then we'll talk about the banking sector. But anyone tuning in, today is March 16th and Shane's not golfing tomorrow, so we might not sell off.
Maybe
So,
not. Maybe we get a rally. And before we jump into the charts, maybe it'd be helpful to just kind of walk through briefly, like my sort of understanding and simple explanation of what in the heck happened with the government intervening in the failure of Silicon Valley Bank. And so I think there's a simple way for most people to understand this. Is like there are two types of people, two types of customers, I guess, of Silicon Valley Bank in particular. And one of them is like, the ultra wealthy tech mogul guy who banked with them when he started his business. And, it's Silicon Valley. And so Silicon Valley Bank, wow, it's cool. I'm going to put my money there. So guys like Mark Cuban, for example, had like $10 million sitting at the bank, which, isn't a lot of money to a billionaire. But it's a lot of money, to most people. And it's certainly well above the FDIC insurance threshold, which is $250,000. So when Silicon Valley Bank, I'll just call it SVB for short, when SVB, essentially had a liquidity crunch and they couldn't honor all of the cash requests that they were getting from their depositors, and the FDIC came in and took over the bank, what was supposed to happen was that Mark Cuban would only have access to $250,000 the next day, and the rest of his $10 million would be tied up and liquidated over time, maybe 3, 6, 9 months, as the FDIC, the government, would sell the assets off the balance sheet over time in an orderly manner. And Mark would have gotten most of his 10 million back, probably not quite all of it, but a large portion. He just wouldn't have been able to get it immediately. Could have been 6 months. Is that really a big deal? Is that a good reason to have the government step in and save a bank from failing, and guarantee all deposits? Well, I don't think it takes a rocket scientist to say no. I mean, Mark's a billionaire. He probably had $10 million at 20 different banks. It's not a big deal to guys like Mark Cuban for that to have happened. Um, However, you get people, I shouldn't say people, you get companies like Roku, for example, that had $500 million at the bank. That's $500 million sitting in a bank account. So first of all, the entire CFO office and financial team at Roku ought to be fired and maybe sent to prison. I mean that just first of all. Why do you have $500 million in a bank? You know what the FDIC insurance limit is? It's still $250,000. I'm just looking right now. Roku has 3,600 employees, according to TradingView. And I don't know, let's just say, for example, Roku has a payroll a monthly payroll of, I don't know, $500,000, $250,000 a month in payroll going out to just regular employees, not just to their C-suite, their chiefs and directors and all that, but to like regular people who sweep the floor and program computers and just people like you and me, right? So these people, because Roku was so irresponsible to have $500 million at the bank, they only have access to 250,000, and it might take 6 months, like I was just describing, for them to get access to the other $500 million. Well, in the meantime, they're not going to be able to make payroll with just 250 grand. They're going to run out after a month. And guess what's going to happen is all the employees of Roku simply aren't going to get paid. So can the people, the entry level employees at Roku survive for the next 6 months while Roku has their bank or all their cash tied up by the FDIC trying to liquidate SVB in an orderly manner? No, those people are going to starve to death in the meantime. They're going to have to find a new job. It's just going to be a disaster. And so that is arguably why the government intervened. Whether you think they should or not, or whether they had to or not, is a whole different matter. I mean, I think it sucks that people go to work for a company and they expect that the chief financial officer is responsibly looking and doing due diligence and organizing the company's finances in a way where that kind of thing could never happen. It's really not that hard. I mean, the CFO ought to call up Elevate and say, hey, I got 500 million. What should I do with it? And we would organize it in such a way that no bank failure in the world would ever have an impact on that cash. If that securities that mature every week to be able to make payroll, and all the banks in the world could fail and it wouldn't be a problem. I'm being hyperbolic. That probably
Yeah.
would be a problem. But you get the point. It's just like, because it's simple to leave $500 million in a bank and it doesn't require any effort or any brain cells to be burned, like trying to do a little bit better and do due diligence and protect your employees. It's just so irresponsible to depend to like look at it and say, if something bad happens, the government will step in and they'll backstop everything. Like, that's the problem, is every time that the government intervenes and does something like this, the people who should have to pay attention ultimately use that as like a reason to not care as much as they ought to. If the government let this bank fail and let Roku's 500 million get tied up, and along with a whole host of other companies that would have been in the same position, Roku is just a worst offender with the biggest dollar amount. If they would have let that happen, maybe, just maybe, those types of investors, those types of companies would think twice next time. But instead, they get a lifeline, they get saved, they get bailed out. I don't care what you want to call it, it's a bailout. And then there's no consequences. And so I don't know who said it or where I picked it up, but capitalism without bankruptcy is like Christianity without hell. It's ridiculous. It's like, it's totally ridiculous. And there have to be consequences in order for people to change their behavior. So I don't know. I'm not advocating for people to not get paid and for people to, be in bad situations like that. But at the same time, bad things happen, and you roll with it. And that's what makes this a great country, is what used to anyway, is that there were consequences. And we've all seen soup kitchen lines, from the 1920s, and like our forefathers like dealt with this stuff, and we haven't learned anything. And it's so anyway, I'm really frustrated and bothered by the whole situation, and we'll get into it more, but I just wanted to spend a minute kind of letting people know, that when it comes up, that's what happened. I mean, is it more complicated than that? Yeah, sure. You could use all types of big words and dial it down to, get very granular, but in broad strokes, what I just explained to you, the difference between Mark Cuban and Roku and its employees, is effectively what are the important factors and what happened here recently. And I don't know. I don't think it's over. I think it's just kind of the beginning. So we'll see what happens from there. Kyle, do you have
Yep.
anything to add? Any thoughts on that?
I think the big one you hit on is moral hazard.
Yeah.
So banks don't pay you a good interest rate. They might not pay you anything. And if you bail them out and make it so people don't have to think about diversification, then you get people that park it all in the wrong spot. The other thing is that, I share the same view, but slightly different, where, people do need to have faith in the banking system, because if everybody just does runs on banks all the time, banks can't operate. So I think that's a consideration, but or bailing out a poor business, unacceptable. I don't, it sucks. People lose jobs and that's hard, but you're going to have shell companies that don't operate well if you don't let them fail and innovate. And that is capitalism, right? You want to
Yeah.
cleanse the system sometimes, and the strongest will survive. Innovation takes place, and it helps everybody.
Yeah, and you raise a good point. I mean, the irresponsibility also lies on SVB for focusing solely on the tech startup business, which, I mean, if that's your customer base, they've been struggling and pulling money out for the last 2 years. They haven't been putting money in. Nobody's making big venture capital investments to give these companies money to make a deposit to the bank. All they've been doing is drawing it down constantly. And that,
Mm-hmm.
so focusing on such a small group of customers is what put your bank at risk. Like that's irresponsible as well.
Yeah.
And that's the kind of stuff that the Roku CFO should have known when he decided to keep $500 million there. It's like, hey, this is kind of risky. Maybe I should put some of the money, somewhere else. Um, so
And
yeah, there's a lot of levels we could dig into, but there's just so much irresponsibility. It's the everybody gets a trophy mentality, the participation trophy mentality. Like it'll all be okay. Somebody will come to the rescue, and it's just I don't know. The more that happens, the more, like you said, moral hazard takes over. So anyway,
yep.
we could beat that horse to death for at least an hour. Might as well move on because there's been plenty of coverage elsewhere. So that's our take. And I guess from there we'll jump into the deck.
Sounds good. And just while we're flipping over, the last part I'll say is, you know, what people need to take into consideration is that banks, what they do is they look at deposit runoff. So that's the assumption that, there's a normal model for how many deposits are lost every year if interest rates go up. And this was an example of, using historical occurrences, not always the best, because when you have run on the bank, they don't have that in 10 years of data. And that's kind of the regulatory requirement. So, big difference between assumptions and reality. In this case, we had reality was different. So, but wrapping that up on banks, I thought this was interesting. So if you go to the FDIC's website, they publish from 2001 to present how many bank failures there have been and what the total assets were. And this is something else. So let's look at 2008. 25 banks, went under, and then the asset value of that was about 373 billion. Let's go to 2023. Two banks went under, almost 320 billion. So just
This
shy of
this
2008, and it was two banks. Just to give you an idea of how large of a bank went under.
the second and third largest banks in the country went under in like 2 days time.
Mm,
That's Silicon Valley Bank and then Signature Bank New York. That's crazy.
yeah. So,
That's
and that
crazy.
is why you think about it, if the government didn't step in, and this is the real problem, it creates two tiers of banking systems where the too big to fail, which I'm sure people have heard that term, the government, if they just let them fail, imagine how many smaller banks that were not perceived as being worthy of getting saved would go under as a ripple effect. So, this it's kind of ridiculous, the moral hazard, all that you and I talked about, but two banks that large going under, not good. And yes, the taxpayer is going to step in and help save that.
Don't tell anybody on CNBC that it's not good, Kyle. You will not be invited back.
Yeah, I'll try and stay away from that. And does that mean we're going to fall through the floor in the markets and it's all over? The markets are saying a different story. So just right here is a perfect example of fundamentals do not always line up or time perfectly with what's going on in the markets. But I don't know, Shane, anything else on this one, or should we move on?
Nope. Next is good.
So then this is what's that, like the Madden curse? That's
Yeah,
what this
exactly.
looks like.
The Madden
And
curse or like the magazine cover indicator is like a real big one. It's a real one. Every time Barron's comes out with something on the cover, like do the opposite of that. Um, I guess Forbes, we can put Forbes into the mix too, because Forbes put Silicon Valley on the cover of the they're America's best banks, and you can see this is a Twitter post from SVB, and they are very proud to be on the ranking for the 5th straight year too. So apparently Forbes got it right for a few years, but has also been named to the inaugural Financial All-Stars list. And that was on February 16th. And so literally less than a month later, it was taken over by the FDIC. So the All-Star got taken over by the FDIC. It failed and was unable to honor customer deposits. They did
Yep.
update the article, thankfully, but just kind of ridiculous, right? This is why I make fun of the Cartoon Network over there at CNBC. Like, it's mostly do the opposite. So be
And
careful.
Shane, something I wanted to point out on a broader topic, this is exactly why technical analysis works,
Yeah.
right? Like this bank, they've been audited, they publish financials, they have all this coverage, and what was under the hood? Something nobody saw.
Yeah. You
And
could
that's just it. I don't know the chart or what the ticker on that one is, but
it's funny. Last week we said we should have put in the SI because the SI also failed. They voluntarily are on our unwinding operations, so they're not even included in the two banks that failed technically. SI is Silvergate Bank, the crypto bank, and so that we talked about that last week because that was going on I think Wednesday last week that we recorded. I don't remember exactly. Maybe it was Thursday. I don't know. A lot's happened in a very short period of time. It kind of all runs together, but Silvergate, we didn't put a chart in for. SVB symbol is SIVB. We did not put in a chart for that one either. Maybe we should have. And Signature Bank New York is SBNY.
mhm.
B is in bank, SB is in bank, NY. And yeah, so if you would have looked at the technicals, there were definitely points at which you were like, wow, this made a fresh low. I'm getting out. Even though I love the fundamentals, even though this is an admired bank on the all-star list at Forbes, for some reason, people are selling the stock. And when it makes a new low and people are suddenly willing to sell the stock for a price they were never willing to sell it for before, you should pay attention and probably get the heck out. And
Yep.
that's how technical analysis would have saved you from going to zero basically on this bank.
And that's one I was just looking at a chart on my screen. So it's been trending down for over a year, below all your averages. And somebody, a value buyer, might see that and go, "Oh, look how cheap I can get it for," and then they get wiped out when the news comes out. So just a good lesson on how that works. But
That's what you call a value trap.
yeah. So and then here, Shane, I'll let you talk to this one, but
Yeah, by the
FDIC
way,
and
I'll also say this, sorry to interrupt you, but like, you know, people can always say things are cheap when they're using the wrong numbers. If I'm using last year's earnings number to calculate the PE ratio, but next year's earnings aren't going to be anything like last year's earnings, maybe they'll be 1/10 as much or nothing. Well, how cheap is it based on what the earnings are actually going to be? And nobody knows. You can't predict the future. But if you're just using historical earnings and projecting that into the future, when we've had a regime shift from easy money policy to tight money policy, that's why things look cheap. They look cheap based on the world we used to live in. They look stupid expensive based on the world we're going to be living in for a while.
mhm.
So that's how things end up looking cheap that really aren't cheap.
Yep.
Anyway, on the left over here, you see a letter from SVB and the FDIC because the bank is actually owned by the FDIC now. So we got a new CEO of Silicon Valley Bridge Bank, right? So it's the Bridge Bank now. And they are open for business. We are hard at work bringing all systems and solutions back online to support you. We are making new loans. That should terrify you. This business is making new loans.
And so this is something I just have to wonder, and I'm no expert on this one, but in order to make new loans, you have to, like I was saying before, model how much you have for deposits and what the runoff is if rates go up and all that. So do they use the FDI backstop amount? Is that what they get to loan? or,
I mean, this is, yeah, this is the safest bank in the world. Suddenly, it's backed by the full faith and credit of the United States government. Suddenly, it's like, I mean, dude, I can't even begin to imagine how, like, I can't even put into words how stupid this is. It's the dumbest thing I've ever heard. And I mean, I don't blame them. This is what I would like. It's true. Is there a safer bank in the world than the one that is basically owned and operated by the federal government now? I
Mhm.
mean, I don't care if you're JP Morgan or Wells Fargo, like you're not backed by the people who have the printing press for dollars. It's ridiculous, you know?
Yeah.
Not that the FDIC and the Treasury are the same, but you get the idea. Like they've guaranteed all the deposits. They probably should not have. I realized that that was going to hurt regular people. I get it. But like you can't save everyone, man. Like if every regional bank had this problem, the FDIC doesn't have enough money to backstop all of them. It's not even possible.
Mhm.
So yeah, dude, I don't know. I can't really get into all the details of all of it on this call. I just look at this letter and I look at it and I'm like, you people got taken over by your whole bank got seized by the government and you're actively opening new accounts of all sizes and making new loans and asking people to bring the money back to you that they just took away. And I just and you see this on the website, like they're advertising that it's backed by the FDIC. If you go to the website, siliconvalleybank.com or whatever the web address is, I don't know. But like go there and you'll see that message and it's just like, why? Why not just shut it down and take it all away and just be done? Like there have to be consequences, otherwise nobody learns anything. You know,
Yeah.
like what would happen if you didn't feel pain when you put your hand on a hot stove? You would
Yeah.
probably keep doing it and you would be full of blisters, right? Like the pain is the feedback mechanism that helps you stay safe in the long run. That's how God designed the universe, man. And
And
I don't know, these
Shane,
people like to play God. Sorry, I'm on a
I,
rant.
yeah, I can tell. So, but I wanted to point out one thing. So these guys, they wrote a letter identifying this, and rightfully so. They do have to operate and let everybody know. But what I like is Charles Schwab. That's one kind of got called into question, and guess what they did? CEO went and bought his own shares. So
Yep. In his
seeing some
personal
stuff like
account.
that's a good vote. So, but kind of step on through here. I know we got some slides to look at, but Janet Yellen has never been wrong, along with any Fed chair, and you know, letting us know that the banking system remains sound,
Yeah, so just
which
before you go to the next one, like this is going on today. This is happening today. She's testifying in front of Congress, telling them literally that the banking system remains sound. Now, to me, that is like so triggering because we have heard this exact language before, and you'll see. You're going to see in a second where we have heard this before and when was it that we heard it and what happened afterwards. So yeah, Mr. Paulson, right? He sat there, he testified that literally our banking system is a sound one. This was in 2008, July of 2008, just before things real. This is after Bear Stearns, so this is 3 months after Bear Stearns, and about 2 months before Lehman Brothers collapsed, and then the
it,
whole financial system crumbled in something we call the Great Financial Crisis. That's what it's called. And this knucklehead was out literally 2 months before it all really got going, saying how safe and sound our banking system was. And then you look at today what this woman is saying to people. She either has no idea or she's lying.
and I think it's one thing I want to point out for clarification, Shane. When we're talking about the banking system and maybe it not remaining sound, are we separating a company that might go bankrupt and it's just not around anymore, but depositors are safe, or every man for themselves, the New World War? Um,
Well,
I think on my side, I think there could be some other banks that are going to go under. Um,
well,
but
to be Chris, oh, go ahead, finish.
but but the FDIC insurance and the way things operate, people are okay with having those banking relationships. Maybe you should look at how much is in there. Watch that FDIC cap. But that's kind of my take on it. What's your take?
Well, first of all, to be crystal clear, I am not trying to incite a bank run. That's not my purpose or goal. I don't think that's a good idea. Every single bank in the world, well capitalized or not, is subject to a bank run at any time. That if so banks borrow money from you through your deposits in your checking account, and they depend on the fact that you're not going to need all that. Every one of their customers is not going to need all that money all at once. And so they take that money and they invest it in mortgages and they invest it in other long-term, long-held assets, and the bank earns a spread. So ideally, they're borrowing from you, paying you very little for the money on your checking account, and then lending the money out at higher rates, and then they make a spread. If they couldn't do that, there would be no point in having a bank. Nobody would ever offer a bank. We would have nothing but state-run banks that were not run for a profit. Banks are run for a profit. I think a profit motive is a good thing, and every single bank, even the responsible ones, can fail under a bank run scenario. If every single depositor wanted every single dollar in every single account on the same day, I don't care how well capitalized the bank was, it would fail. So I'm not saying that that's inherently, a problem or a bad thing, because that normally doesn't happen. And I don't think it's a good idea to try and go get every dollar you have out of a bank. Like, how's your debit card going to work? How are you going to pay your mortgage? Mine's on auto pay. It needs to come from somewhere, right? So like, you got to have your cash somewhere. But yeah, having cash over and above $250,000 at any one bank is ridiculous. It's too easy to move money around these days. Like, it takes 5 seconds to move money from one place to the other. So if you're lucky enough to have more than $250,000 of cash, don't leave it all at one bank. It's pretty simple. Go to Charles Schwab and buy CDs from 58 different banks, or 100 different banks in $250,000 increments. That way, if one of the banks fails, you don't have to go get your money. You're not even worried about it. You don't have to participate in the bank run. Like, there is a good way, a smart way to organize your cash so that this kind of stuff, when it happens, and it always will happen inevitably, it just doesn't matter to you. We have clients who have a certain number of treasuries. Like, let's say you need $10,000 a month in your retirement. You can have $10,000 worth of treasuries mature every month for the next 3 or 5 years. And when crazy stuff in the market happens, you can sit back and relax and go to the beach and say, man, that sucks for someone, but I'm all good. My income's all set. I've got it in places where I don't have to worry about it. I don't have to run out and get it. We're all good.
Mhm.
So, but I don't think that the banking system remains sound. I think the banking system is in absolutely terrible shape because the government printed too much money, gave it away to people who all deposited it at banks, and then the banks took it and invested at stupid low yields that make no sense in today's environment, which we'll get into in a second. And so I can see a whole lot more banks failing. I don't think this is over. I think it's probably just the beginning, and it probably moved the issue out one level and probably bought some time. But you got to remember, like, the US banking system being fundamentally sound in 2008 led to some of the highest unemployment rates we've ever seen outside of COVID, some of the highest homeless rates we've ever seen, the most mortgage foreclosures we've ever seen, and people literally died, like, so saying that the banking system is fundamentally sound doesn't mean really squat. It just means that the banking system will still exist tomorrow, but many of the banks in it might not, and many of the people who are customers of those banks might, you know, might have severe adverse consequences in the interim, including but not limited to losing their job, losing their house, losing their capital, losing their freedom, losing their liberty. Like, these are all horrible things that are a direct result of the unsoundness of the banks. So I don't think the banks are anything close to sound. I think it's terrifying. And I would never keep a penny of my money at a bank over and above the FDIC insured limits, because I have zero confidence that that's a true statement.
Yep. And what's always interesting with that, Shane, is just, hey, if you do have money parked somewhere and there's a risk involved, it's nice to know you're getting a return. I think that's the big one, right? Is
Yep.
I can go buy a stock, maybe it'll go up, maybe it'll go down, but at least I have that upside. So
Yep.
something to look at. But here's one, Shane, you pulled this up, but it's back to that the Fed's assumptions they use when they're doing balance sheet modeling and interest rate risk management for banks. Yeah, this is
Yeah.
kind of what they look at.
This is the severely adverse scenario, keep in mind. And they have the worst, like over here on the left, we have the worst case scenario assumes interest rates for treasuries ranging from 3 months to 10 years never exceeds 1.5%. Today, we're at 4 to 5% on those things. I mean, we're more than what? That's 2, 3 times the worst case scenario that they've projected. And you wonder why the banks passed the stress test. It's because the stress tests aren't stressful and they don't represent even current economic reality. These people built a financial system that only works in low and decreasing interest rates. And now that's not the situation that we have. And like there is a 30-year US Treasury that you could have bought. Somebody did buy it in 2021. It's 2 years ago that paid 1.25% for the next 30 years. Today, you would have paid a dollar for this bond or $1,000, say, for this bond, right? It matures 30 years at $1,000 and it pays 1.25% interest for the next 30 years. If you tried to go sell that bond today in the market, you would get about 50 cents for it. So you bought a 30-year treasury for $1,000 and you go sell it in the market today, you would get back $500. You lost 50% of your money in a 30-year US Treasury because you bought it when rates were low and now rates are high. Like
Yeah.
that's what every single bank in the world, that's the problem that they have on their balance sheet is they took in all this capital back in 2021 after all the COVID stimulus money was printed and people put it in the bank. The banks then took it and bought these longer term assets that pay a very low yield. And if they had to value them at market prices, they would be insolvent, period. Just that's it. So the banking system, based on that, in my definition of soundness, is anything but sound. And that's where we are. And it's just, to me, these first few banks are just the first few dominoes to fall.
And Shane, something to point out, if anyone wants to look at maybe a historical story that explains this a little better, look at long-term capital management and their
Yeah.
failure.
Yep.
That was based on modeled assumptions, and they used a ton of leverage and they did really well for a while until it didn't work. And you fall outside of these assumptions and there's some real risk there. And some banks are structured differently than others, and that's really important to point out, is that some, they keep none of their mortgage book, they sell all of it, they keep the mortgage servicing rights, they have revenue, but they're not really subject to the rate changes. Some banks are a little more speculative, Bear Stearns, Lehman, ones like that. So it's important to kind of understand what's there, but this is a test given out by the federal government to kind of manage the banking system and some assumptions there. And it is surprising, these aren't necessarily aggressive assumptions. So yeah, it'll be interesting to see how it all plays out with rates going up, but
Terrifying in my opinion.
yeah. So what does this all mean for the markets? And this is exactly what I was talking about, Shane. So I'm long the market right now, ES, not long term. So let's clarify that. My holding period, it might be a day, but the big thing, you're seeing these headlines, banks going under and everything. How on earth is the market going higher? And short term, just people covering positions. It could be as simple as that. Hey, maybe it is, setting up a new bull market, and that's when the real bad news can hit, is when it's finally all out. I'm not going to place a bet on, either one. We're still not at any new time or new all-time highs or anything, but this chart illustrates it perfectly that just because that news came out today doesn't mean the market's going to drop 20% tomorrow. So let's look at the historical context, and Shane, I'll let you talk to this.
Yeah, I mean, after Bear Stearns filed for bankruptcy and effectively was sold to JP Morgan for $2 a share, the market rallied for several months. It came within 8%, 9% of a new all-time high after Bear Stearns went bankrupt. And, everybody in the government was coming out and saying there's no problem. Remember, Paulson was right around here telling us that You know, the banking system is sound right before the great financial crisis really got kicked off. And so the market can rally. You know, everybody said like, oh, you know, the market was going down into this Bear Stearns thing, and when it was all resolved and they put everybody out in front of Congress and got everybody on CNBC talking like, wow, that was a close call. At least everything's cool now. We're safe now. Everything's fine. And it was anything but fine. If you watch the movie The Big Short, what you'll find out, you'll see Michael Burry going crazy because he sees all these things happening and all these banks kind of having trouble and all these different, you know, bankruptcy filings and mortgage foreclosures happening and so on. And you know it's anything but fine. But the banks are taking their time getting the toxic assets off their balance sheet. And once the banks finally get all the toxic assets off their balance sheet, sell them into the market, they finally started pricing them correctly. And then the bottom started to drop out and you had Lehman go bankrupt and then the market dropped, you know, 50% roughly from there. So it wouldn't surprise me at all to see something similar play out today where, you know, ironically, this was Monday, March 17th in 2008. And this week we had Monday, March 13th, I think, right? Was it the 13th on Monday? And that's, you know, Signature Bank failed, I guess, on Sunday, the 12th, and Silicon Valley was the prior Friday. So it's kind of interesting that timing. Wouldn't surprise me at all to see the market rally again, maybe until mid-May, right? To a new high or a new relative high, and then kind of sell off again for a while, maybe all the way until September, right? That's when Lehman failed. So between March and September, you got 6 months of, you know, up and down, basically a flat market, right?
Mhm.
Flat market that whole time. And then it turns out that, oh, everything was not fine. Everything was very far from actually being fine. It was really bad. And the whole time, you know, people were just kind of complacent and not paying close enough attention and probably not raising enough cash in the interim. And then boom, the bottom dropped out and it was too late to do it. So, you know, history isn't going to repeat exactly, but it often does rhyme and it's close. And so, you know, the one lesson of history that's probably the most important, as Aldous Huxley said, is that men don't learn very much from the lessons of history. And
Yeah.
so you might want to pay attention here and be the outlier. I think right now playing defense is the best thing. You know, in a long-term portfolio, I'd be looking to kind of trim profits on any type of bounce in the market on these headlines, because underlying is a whole lot of real serious financial issues that aren't going to be papered over by saving one or two banks. It just
Yeah.
isn't going to happen.
And Shane, you and I, we talk about this all the time, but you know, the job as a trader and investor is to manage risk. And we don't know if this is going to happen, but you want to be prepared in the event that it does. Where do you, you know, trim? Where do you start to buy into this? And that's really it. So, hey, if we're in a short-term uptrend, great, but where's that level that you're going to get out if this wants to play out? So
Yeah.
we'll see. Looking at the SPY, Shane, you're talking about this. Some I hear, look at trying to cross right back over that 200 day. Day is not over by any means, but here we are again looking at chart, and this doesn't look nearly as good as the chart you certainly would not expect to look good. But
Yeah.
right now, I'm watching, so 380 falls below that. We're back for a big flush lower. But right now, recapturing the 200 day, if we hold that and then get through the Fed meeting next week, yeah, it could move higher, but you know, I've been saying this. If I predict what this market's going to do, I'm kind of in the camp of I think we just go sideways and chop for a while. I think that's the most painful trade anyone can experience.
Yeah, last week I was saying probably just go sideways for a while. I thought the MACD would have gone green here, but obviously we had the bank failure situation bring things down. So the MACD hasn't even turned green yet, still working on it. Won't surprise me at all if we basically go sideways around the 400 level until the MACD finally does turn green. I think the upside's probably limited. And eventually, you know, after going sideways long enough, we will drop lower. That's my current thinking. And you know, if I had a line drawn here, that there would be some resistance. So, you know, this going up to 400 and then turning around and coming down, with the MACD turning around and coming down. I mean, that's my base case for what I expect to happen. You know, as the joke goes, man plans and God laughs. So who knows what will happen? I don't, I don't pretend to, I wouldn't trade based on that being what I think will happen. And it's real easy to sit here with no money on the line and say that's what I think will happen. It's a whole different matter when you got money invested and you're seeing real losses or real gains on your screen. Things change. But if I had to predict, which I don't, but that's kind of how I see it going right now. I mean, it looks pretty bullish overall. We've got we've got the low here, we've got a higher low here. And even if this holds as the low, it'll still be another higher low right there. So, I mean, that's bull market behavior. You got the 200-day moving average here, but the 50-day moving average is above the 200-day. So, interestingly though, the 200-day moving average did tick down, and we'll look at that a little bit more clearly in a second. So we're
Yep.
not totally out of the woods yet. I wouldn't be going aggressively long, even on technicals, but with the fundamental backdrop, I definitely wouldn't be going aggressively long.
I agree. And here's one, man, Shane, if you don't tell me anything of what's going on in the market, I look at the NASDAQ right now and I want to buy every bit of this I can.
Yeah, if we did a mystery chart with no ticker symbol on it, you'd be like, "What is that? I want to buy that. Holy crap, that looks bullish."
Yeah, and what I'll say about this, so why might it be doing this fundamentally? The 10-year yield has absolutely just totally reversed. It was shooting higher, it's reversed, and we know that the NASDAQ is more interest rate sensitive. But man, just you have this flag where it's consolidating here, and I'm calling today a breakout. You could see a little retest come back in, and as a trade, man, that's awesome. Get long right there and take it up. Maybe this is your target up there at about, was that 335, the August highs.
Yeah,
But
something like
I
that.
see that, and I'm not calling my broker and saying, "Oh my God, get me out of everything and anything I own." I'm seeing this and going, huh, this fundamental backdrop, as we always say, it looks terrible, but it's a nice little chart right there.
Yeah, dude, it looks so bullish. I mean, it just really does. I don't even know what else to say. It shouldn't. I guess the only thing I would say about Qs is that um it probably looks better, looks more bullish than the S&P 500 because it went down so much more than the S&P 500 while it was falling. So it has a lot further to go on the upside, and the 200-day moving average came down a lot lower. The 50-day came down a lot lower than the S&P 500, so it looks better on the recovery side. I mean, the Nasdaq is just more volatile anyway, so no surprise there. But I think it looks better because it looked worse. That's basically, why is it up? Because it was down a lot. And
Yeah.
I think that's, I mean, I know that's simple. It's like when you call the tech people and they're like, well, have you tried unplugging it and plugging it back in? It's like, well, that's simple. Sometimes the simplest answer is the best answer. So I think that's kind of what we're seeing here. And actually you see the MACD actually turned green today. I don't know if y'all can see that, but I can barely see it. So I expect that to kind of hold up. I expect the 313 level maybe to hold as resistance. And then I kind of expect things to roll back over lower as we kind of play out the fundamentals that we've been talking about so far in this call. So
Yep,
anyway, yeah, on technicals alone though, that thing looks beautiful.
it does. And then here's just a line chart of the SPY, and it's showing us we're just crossing back over that 200-day. So key level
Well, no,
there,
this is
right?
showing you is that the 200-day is declining, right? It's
Mm,
declining from its prior. It made a new low yesterday. So the prior low was right here, back on February 27th, but as of yesterday, it made a fresh low. So we have to restart the 21-day clock on a rising 200-day moving average for 21 consecutive days is kind of one potential measure of if we're in a bull market or a bear market. So this one, it stopped going lower and tried to tick higher for a while, but then when it crossed below the SPY crossed below the 200-day, it dragged it back down again. So that's what this is showing, is just looking at which direction is the 200-day moving average going. Is it pointing up or is it pointing down? Right now, believe it or not, it's actually pointing down. So we're looking for a point at which the the 200-day moving average on SPY begins to trend higher as an indicator that we might be back in a bull market. So we have not achieved that yet.
interesting. And then NASDAQ,
Same,
same, came
yeah.
slight little cross there, but restart
But
the clock as you.
Well,
describe.
this one though hasn't made a new low. So this one, the low was 290.03 back on March 6th, Monday, March 6th. And that low is actually held. So the blue line here has not crossed below 290.03, and now we're up here. So it should drag it higher. But that's only since March 6th, so that's not 21 days quite yet. So we got a ways to go. But again, different pictures for the S&P 500 and the Nasdaq right now. I think the Nasdaq looks more bullish than the S&P 500, and so this is just more evidence that that's the case. So we'll just keep an eye on this. Again, we're just paying attention to this blue line, right? Is it going down or is it going up? And that's what we're focused on. I don't really care so much about this gray line. That's why I have it kind of grayed out, if you want to call it that. So anyway, just focusing on the 200-day moving average direction.
Got it. And then Shane, you and I, previous calls were talking about the 10-year yield, and it looks bullish, it's going higher, and you had a major retest here. So it retraced all the way back here. This 3.4 level, if we go below that, I mean, it's nice because we have low rates, but it also scares the heck out of me because I'm wondering why everyone's going to fixed income.
Yeah, it's funny, man. I mean, I can't believe that actually held. I'm surprised that it held. Because everybody wants to go buy 10-year treasuries. They're like, oh my gosh, 10-year treasuries at 4%. My money's not safe in the bank. Let me go buy some treasuries, please. So this is reflective of the bond price going up because everybody was buying bonds for the past week while the banks are failing. This is more evidence that like it's not all good. I don't care what they say on Fox News Business Channel or CNBC or whatever. Like they have no idea what's going on. They're not even paying attention. So underlying, it's pretty frightening. And we're just right back to the support level and the 10-year yield. So, this also like when if you get stuck in a vacuum and you're just looking at the 10-year yield going down, you're saying, wow, let's buy some tech stocks because yields lower means buy tech stocks. And that's why you see the NASDAQ going higher. But when you back up one step and you say, boy, do I really want to own tech stocks with a liquidity crisis unfolding in, the global banking system? No, you don't. I don't care what the interest rate is. You don't want to own tech stocks in that environment. So, things are all interconnected. You can't just draw specific linear correlations and operate in a vacuum. You have to take other things into consideration.
Yep.
And that's the 10-year for now.
And then here's a big one. So the question has been, well, what's the Fed going to do? They'll stop raising rates, right? Because now it's a little scary. Well, sometimes you can look across the pond, see what those banks are doing. And right now, the ECB, European Central Bank, they went ahead and raised it 0.5 point. So, I see that and I think maybe, next week's just another week up at 0.25 point. And then what does that all mean? So you can see the US dollar again. It had retraced, but it's kind of coming back up here to this uptrending line.
Yeah, but
I can't draw.
today is a red candle because of what the ECB did. Because the ECB hiked by 50 basis points, that makes people buy euros and sell dollars. So every currency transaction is a pair, and people are selling dollars to buy euros because the interest rate went up in the Eurozone by 50 basis points today. I do think that the 50 basis point hike is indicative of what you might see out of the Fed next week when they come out and try and say, hey, yeah, I see that there's a banking crisis going on, but inflation is still 6%.
Yeah.
Like we got the CPI data. We didn't put in a slide for that either. We got too many slides and too much to talk about. Can't hit it all every week, unfortunately. But I think that indicates to me that Jerome Powell will stick with the program and actually hike rates by 25 basis points next week. I don't think he'll do 50. I certainly don't think he'll cut interest rates. I think it's reasonably possible that he'll pause and do nothing, no hike at all, no cut, no hike. But my base case is that they hike by 25 basis points again next week because inflation is still 6%, which is 3 times their target level. And banks failing doesn't necessarily have a direct impact on inflation, but hiking interest rates and letting assets roll off the balance sheet does. And
Yep.
so you don't like going back to what I talked about at the beginning, you don't intervene in a bank failure to save the little guy, right? The little guy at Roku who's not going to get paid. and then turn around and cut interest rates and slap the little guy on the face with higher eggs, milk, gas prices through cutting rates. You don't, you don't save him in one way and then attack him in the other way by causing inflation to go higher through cutting rates. So I think Powell's smart enough to know that, and I think he will, I think he'll continue hiking rates to try and get price stability under control, because price stability is what's going to save these banks in the long run anyway. So we need to get rid of this high inflation, and we're going to do that through higher interest rates. So we'll see what happens with the dollar in the long run. But for today, that's a red candle on the dollar, because people are looking at the euro because it hiked rates. When we hike rates next week, it'll be the exact opposite.
Yep. So, and then Shane, this one, we got to talk about this. This is the difference between being an analyst and a trader. So oil, it was coiling. I thought we were going to break out. I shot you a message, and I think I said that last time. I thought this was the breakout right there. We hit 80 bucks, high volume. I was all in, and it just broke down and is getting crushed. It goes against everything they've been saying. Said it before, but everyone was calling for $100 oil, even higher. It's breaking down, but Shane, tell us about your experience on this. I think it's good for people to, just understand some of the challenges of trading.
Yeah, so 2 weeks ago, I was like, well, here's what I think will happen. Again, predicting the future. I said, I think it's likely. And I based my opinion mostly on the MACD, believe it or not. I said, yeah, I think we'll get a breakout. I think that breakout will fail. That'll turn out to be a fake out, not a breakout. And then I think we'll drop to new lows, probably around $70. I didn't really think we'd go way below 70, so that surprises me a little bit. But here's the thing. I knew, right? I don't know, I didn't know it like I know my name, but I was pretty confident that that's exactly how this trade was going to play out. And not only did I not make any money on it, I actually lost money because I'm an idiot. And I went long there on the breakout because it just looks so pretty that I had to buy. And I don't trade crude. I trade the stock. So I was long ERX, the 2x XLE energy sector. And I ended up stopping out. Where I stopped out like right. Oh, I lost my drawing tool. I stopped out like right here. So I bought on this day. I was long, and I made all that money. I was all happy, but I didn't close it there, and I stopped out here at the lows of the day that I went in, and I never shorted it. And so I'm an idiot. I also blame being a little busy, so I'll make that excuse. But at the end of the day, here's the deal: it's like I knew what was going to happen, and not only did I not make money, but I lost money because trading is hard. There's
Yeah.
actually a study out there. I wish I could find it. I should probably bookmark it or something. But there was these guys who went to jail for insider trading. They had like all the earnings releases of major companies, before they were come out. These guys only made money like 80% of the time. Or
Yep.
maybe it
So,
was like 20% of the time. Maybe they lost money 80% of the time. It was something ridiculous. But even having the information, you still are not guaranteed to make money.
and it's funny as Shane, I think, tell me if I'm wrong, but once you get that money invested on the long side, it is very hard not to defend that. You might not even be aware of it
Hmm.
psychologically, but
Yeah.
well, now you have a position that's betting on it going higher. It is very hard not to become a bull in that position. And then I think that's something as a trader that's very hard to do, is to have money that's maybe short term long, but then you're trying to go back to short. But while you're in that trade, it's hard to flip and go back to that short bias and make
Oh
money
yeah.
on that. So
It's real hard to do that. I mean, the greatest traders in the world do that very well.
yep. So not always easy. Easy sometimes to analyze, but with that said, oil, no, I'm not long. It broke out of a consolidation that has been in place since December. This thing's got to settle. It's going to take time. Um, it, not looking to make any real long plays here.
We should have the United States government in there buying lots of oil now to replenish the strategic reserve, though. So I do think
Yeah,
there's a limit on how low it will go, at least in the short term. But yeah, I don't see a trade there right now.
nope. And then this one, Bitcoin. God, I'm not touching this, Shane. I can't do it, man. Look at this. We are so long back here. Now it pulled back, an immense amount, kind of retested the 200-day. Now it's going again. I'll leave this to you. So what do you
My
think?
my Coinbase account is substantially longer Bitcoin than it was last time we talked, because last time we talked, it was just starting this breakdown and I had buys at 21 and I had buys at 20. And then as it rose, I made another buy at 25, 20,500. And so my Coinbase account is it's mostly long Bitcoin right now. And you know what's interesting is, like, it did this whole rally while banks are failing. And I think it's just such a great use case for Bitcoin. Like, all these banks are having all these issues and Bitcoin just does what Bitcoin does. It's open 24/7, 365, and it doesn't require anybody to make any decisions or do anything with the capital raised. It's Bitcoin is just Bitcoin, man. And I don't know. I think that's cool. I think it's gonna work in the long run. And I was a little nervous about having, like, I had good till cancel buy orders in at like 20,000 and 21,000. So like I didn't actively go and buy those. And when they filled, I was like, oh gosh. I put in, when those ones filled, my next buy was down here at 16,200. That's where I put my next buy because I was concerned it was going to go all the way down here to the recent lows, you know?
Hmm.
And so I was not at all confident in it, and it wasn't that much money. You know, the amount of money that I have in my crypto accounts compared to the amount of money that I have in my normal trading accounts is like insignificant. So even if I put my whole Coinbase account into Bitcoin, it still wouldn't like bother me if it went to zero, because
Yeah.
I'm not investing that much in it. But at the end of the day, it felt good to pretty much nail the bottom with those. Like, I picked those numbers way back here because I was like, man, this thing will probably go back and retest 20,000. And of course, now you've got the 200-day moving average starting to tick higher. And, you know, it's a little sloppy. The chart's a little sloppy. It's not like technically like tight and perfect. It's pretty loose and sloppy. Um, but I don't know. In light of what's going on in the economy and the fundamental backdrop of just like everything else, to see Bitcoin do this in that environment, it gives me a lot of confidence in the long run that Bitcoin can hold its own as a currency and not, you know, just a tradable volatile asset. So
Yep.
we'll see. It's going to take lots of time for that to play out, but um, I'm definitely a long-term Bitcoin bull.
Good stuff. And then Shane, oh, look at this. Hey, the yield curve, the inversion improved. The world
Yeah.
saved.
Yeah.
Um,
Well, we'll see.
still,
It's still heavily inverted. So the spread is still heavily negative. And as you can see, all these other times we went back to uninverted before the recession started. It uninverted before the recession started. Uninverted before the recession started. Uninverted before the recession started. So
yep,
I mean, chances are it'll go back up here and then you'll still get a recession, which is not a time where you would want to be aggressively long stocks.
yep,
So that's what I see. And that's what happens when everybody rushes out and buys the 10-year bond as fast as they can because they're terrified of liquidity crisis in the banks.
yep.
So not a sign of good things.
Got to agree with you there. Central bank balance sheet still working its way lower. We've talked
Yeah,
about this before, so I don't have a whole lot to add, but
no, this hasn't been updated either. This is still as of February 27th what the level was. So this hasn't changed since last week, but I think it's important to note that even if the Fed stops hiking rates, I do not expect them to stop letting assets roll off the balance sheet. And so this leads to the supply of money being lower, which leads to lower deposits at banks. Shocker. Which leads to liquidity crises at banks. No way. Those are all connected. Yeah, they're connected. I
mhm,
promise you. Not
yep,
in a linear way, but in some way they are absolutely connected.
yep. And then here, so it looks like just the employment report. So if you want to just talk to this,
Yeah, we need to get rolling, but so employers are cutting jobs at a faster rate than they have, you know, pretty much at any time studied. So in 2021 started here, in 2022 started down here and then ticked higher. So we're well above you know, the past couple of years of history, just starting off the year with lots of job cuts. And so I think that's just something to keep an eye on. The Fed's trying to, you know, right-size the job market and balance the job market. And this is one way they'll do it, is by having increased layoffs. So a lot of technology companies. So up here it says job cuts occurred in all 30 industries, but led by technology companies. So do you think there's any connection between technology companies laying people off and the bank that supports primarily technology and startup companies failing? I think that's not a coincidence. So there's still a lot of trouble out there in the market.
Yep. And then for some good news, you got Babylon Bee articles as usual.
Yeah,
And
we'll end with 4 hilarious things. So Biden assures the banks that deposits are safe in Ukraine. Kyle just went ahead and dumped them all on you at once. I guess I'll let you have fun with that. Just check it out, and we'll wrap it up.
yeah, I think for me, the funniest one here is investor relieved he pulled money out of crypto and put it in the bank for safekeeping. That's kind of the funny situation here, is that there really is never a truly safe place to put money. So, it's nice to have the FDIC insurance, but that's the truth. There's risk in everything.
I like this one. I hope the government sends Mark Cuban a tax bill for his, $9,750,000 that he just got for free.
Yep,
That
it's
he
a good
wouldn't have
one.
otherwise had access to. So anyway, yeah. Banks, please stop collapsing. That'll get the job done.
Yep.
Um,
So
anyway, all right, man. Well, that was a good chat. I know we covered a lot of ground and probably did it quickly. But I thought it was worthwhile to talk about all that stuff because it's top of mind and it's everywhere. So even in the non-mainstream media, you're going to hear about bank failures and have questions, and hopefully listening to this kind of at least gives you a little bit of a narrative understanding of what's going on, and you can share, a little bit about that with your friends and family who don't have a full understanding of what's going on. Um, the sign of intelligence is that you can explain things simply to a person who doesn't have the same understanding and background. And so hopefully we've been able to do a good job of that. Our goal here is, to share something of value with you guys, but not try and make ourselves look smart and talk over your heads and use a bunch of big, silly words that, financial jargon and so on. Sometimes you can't get away without it, but let us know how we're doing. Send some comments, add some questions, and we'll be happy to cover some of that stuff in an upcoming call.
absolutely. So Shane, you have a good one. Thanks for your time again, and I'll see you next week.
Thanks, Kyle. See you.
Bye.